Arbitrage pricing theory. It is an extension of capital asset pricing model. The arbitrage pricing theory is based on assumption that there are a few major macro factors that influence security returns. The arbitrage price theory is based upon the assumption that there are a few major macroeconomic factors like GDP growth, like inflation growth, like interest rates, like industrial production index. The arbitrage pricing theory is based upon the assumption that there are a few major macroeconomic factors that influence security returns. In other words, arbitrage pricing theory holds that the expected return from a security is a linear function of various factors affecting the return from these securities in the market. These factors may be interest rate, inflation, currency rates, GDP growth, oil prices, etc. Each factor is represented by a factor specific beta coefficient. As per capital asset pricing model. As per capital asset pricing model, return from security is influenced by RM, return from market, and RM is influenced by all these factors. So here the factors affecting the returns are considered individually. Let's repeat it. The arbitrage pricing theory is based upon the assumption that there are a few major macroeconomic factors that influence security return. As per APT, security return depends upon major economic factors. As per APT, security return depend upon major macroeconomic factors like GDP, like inflation rate, etc. In other words, APT holds that the expected return from a security is a linear function of various factors affecting the return from securities in the market. These factors may be interest rate, inflation, currency rates, GDP growth, oil prices, etc. Each factor is represented by a factor specific beta coefficient. APT holds that the correct price of an asset can be determined using APT model derived expected rate. As per APT, if we want to find correct price of an asset, we require required rate of return. That required rate of return should be derived from APT model. If we derive the required return from APT model, we can derive the correct price of the asset. So, APT holds 2 points. There are two basic points of APT. Number one, return from securities depend on major macroeconomic factors like GDP growth, etc., etc. And number two, for deriving correct price of the asset, we should use APT model derived required return. This method is an alternative to capital asset pricing model. Capital asset pricing model assumes that expected return from a security is related only to one factor, and that is market return. Capital asset pricing model assumes that the expected return from a security is related only to one specific factor, that is market return. We know that market return is affected by various macro factors like interest rate, inflation, GDP growth, currency rate, oil prices, etc. The capital asset pricing model considers the effect of these factors in totality, that is in the form of market return. The capital asset pricing model considers the effect of all these factors in totality in the form of market return. The arbitrage pricing theory considers these factors separately. Macro factors are also known as risk factors. As per the arbitrage pricing theory, expected return is equal to RF plus beta 1 into change in risk factor 1 plus beta 2 into change in risk factor 2 and so on, beta n into change in risk factor n. By risk factor we mean macroeconomic factors. Suppose in an economy only 3 macroeconomic factors are there: GDP growth, interest rate and currency rates. Interest rates, currency rates and GDP growth. Suppose risk factor 1 refers to GDP growth. So here we will see change in GDP growth. And here we will have beta, a specific beta for GDP growth, a specific beta for interest rates, and here we will take change in interest rate, a specific beta for currency rates and change in currency rates. I will elaborate it. As per APT, expected return is equal to risk free plus beta 1 into change in risk factor 1 plus beta 2 into change in risk factor 2 and so on. Risk factor means macroeconomic factor. For example, GDP growth. For example, interest rates. For example, currency rates. For example, oil prices. For example, inflation. These are our macroeconomic factors. They are also referred as risk factors. For each risk factor, we will have a specific beta. We have to find change in risk premium or change in return on account of 1 unit change of a particular risk factor. That will be the beta. So we will find separately beta for first risk factor, beta for second risk factor, beta for third risk factor. This can also be presented as follows: expected income is equal to lambda 0 means risk free rate, lambda 1 change in risk factor 1, beta 1 beta of risk factor 1, lambda 2 change in risk factor 2, beta of risk factor 2, lambda 3 change in risk factor 3, beta of factor 3 and so on. There are two parts of expected return. The first part is lambda 0. It is pronounced as lambda 0. It represents risk free return. In APT, the term risk free return refers to expected rate of return if macro factors remain unchanged. Friends, in APT, the term risk-free return has a very special meaning. It is quite different from the risk-free return of CAPM. For example, in CAPM, risk-free return refers to government treasury rate. Here it is not that. we estimate the values of macroeconomic factors. Suppose we estimate that GDP will grow by 5%, inflation will be at 2%, and on the basis of these macro factors, we calculate our expected return. That expected return here is known as RF. As per APT, the term RF return refers to the expected rate of return if macro factors remain unchanged. Suppose the return from a particular share is affected by 4 factors: GDP growth, inflation, interest rate, oil prices. The expectation is that GDP will grow at 5%, inflation will be 3%, interest rate will be 7%, and oil prices will be at $60. If all these happens, whatever return we can expect, whatever is the likely return, that return is actually risk free here. If all this happens, the share is likely to have a return of 10%. Suppose in that case RF is 10%. So friends, the arbitrage pricing theory, RF does not refer to treasury rate. RF does not refer to risk free rate in the real sense. RF refers to return that we can expect if the macro level factors attain the expected levels. Suppose our expectation is that GDP will grow 5%, inflation will be 3%, interest rate will be 7%, oil prices will be $60. These are our expectations regarding macroeconomic factors. If all these materialize, whatever may be the rate, whatever rate we shall earn, that rate is referred as risk-free rate under APT. That rate is referred as risk-free rate under APT. Suppose if all these 4 events take place, GDP grows at this, inflation is at this, interest rate is 7%, oil price is at $60. Suppose if all these happens, the return from a share, return is 10%. In that case, we will say RF is 10%. The remaining part represents risk premium. The lambda parameters, lambda 1, lambda 2, lambda 3, lambda 4, lambda n represent change in the units of macroeconomic factors that affect risk premium. For example, examples of such factors may be interest rate, oil prices, GDP growth. For example, this may represent change in GDP growth rate as compared to the level which we assumed. Change in inflation rate as compared to the level which we assumed for RF. This may represent your oil prices. Change in oil prices as compared to the level that we assumed for RF. Beta 1, beta 2, beta 3, beta n are referred as betas or sensitivity factors of various macroeconomic factors. A beta factor represents change in risk premium in case of 1 unit of change of macro factor affecting the risk premium. Suppose there is one macroeconomic factor, and that is GDP growth. For a company, its beta is 0.50. It means if GDP growth will change by 1%, risk premium will change by 0.50% for that company. Suppose beta 1 of B company is 0.75. It means if GDP growth will change by 1%, the risk premium of B company will change by 0.75%. So beta 1, beta 2, beta 3 and beta n are referred as betas or sensitivity factors. A beta factor represents change in risk premium in case of 1 unit change of a macro factor affecting the risk premium. Beta value of any factor is taken as 1 if the security has average exposure to the factor. Arbitrage. As per arbitrage pricing theory developed by Stephen Ross in 1976, if there are two assets which have same risk, if you can find two such assets which have same risk, theoretically their expected returns should be same. If there are two assets which have same risk, theoretically their expected return should be same. If their expected returns are different, the arbitrager will sell the asset having lower return and buy the asset having higher return and have some profit, and that will be your risk-free arbitrage profit. Suppose there are two assets having same risk, but A has got return of 7%, B has got return of 8%. You can make profit by short sell A, borrow and sell A, and buy B. You will have arbitrage profit. Question number 4.88. Please refer to the chapter Risk and Return of the textbook. Please go through the question thoroughly. In this question, we have to find the expected return from two securities A and B. We have to find the return of a portfolio made of 40% of A and 60% B. Expected return of A, lambda 0, lambda 1, beta 1, lambda 2, beta 2, lambda 3, beta 3. This is our RF. We assume macro factors at certain levels. There are three macro factors. We assume their levels. If those levels are achieved, whatever will be the return, that return is known as risk-free return here. That return is denoted by lambda 0 here. This represents change in first macro factor. This represents its beta. Change in second macro factor. This represents its beta. Change in third macro factor. This represents its beta. We are given it is 7%. We have taken 0.07. We are given 8%. Change in first macro factor is 8%. Change in first macro factor is 8%. We have taken this in absolute term, so we have taken this also in absolute term, or we could take this and this all in percentage. We have taken all the lambdas in absolute term. This we have taken in absolute term. Instead of 7%, we have taken 0.07. Instead of 8%, we have taken 0.08, and this is beta of first factor. This is lambda 2 given in the question. This is beta 2, this is lambda 3, this is beta 3. We get the expected return of 13.70%. Similarly, we calculate expected return of B, lambda 0 plus lambda 1 beta 1 plus lambda 2 beta 2 plus lambda 3 beta 3. We are given lambda 0 7%. The values of lambdas are unchanged because they are for economy as a whole.